Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, President-elect Trump is furious as China's latest power move is escalating tensions. I'm going to show you what's coming next, because if you think the answer is tariffs, well, hang tight, because I'm going to show you what I think is actually going to happen, and it's not what you think. But there is one thing we do know for certain. Well, that is hell is coming for China's economy, and I'll show you why. Plus, we have a sponsor for today's show. I'd like to welcome Resolve AI back to the show. You can find them on the NASDAQ under symbol RZLV, and they do AI for retail, and they boast Microsoft as one of their key partners. And we think their stock is set up for a 13% short-term move, and as Wall Street looks to funnel money into more AI companies, we're going to show you how we think their stock could break out for a 63% rally. Stay tuned to the end of the show, or check out the pinned comment or description for more information. Now let's over to Bloomberg, where he picked today's story up with a headline: as China nears a record $1 trillion trade surplus as Trump is back. And we know that President-elect Trump does not like the fact that China runs massive trade deficits, and well, the real numbers are now telling us it's getting even bigger, and he intends to put a stop to that. But the problem is, what you think is actually going to happen. I'm going to show you what's going on in the markets today that may change everything you think about what's coming for China, except the fact that hell for their economy is coming, and sooner than you think. The difference between Chinese exports and imports is set to reach almost $1 trillion if it continues to widen at the same pace as it has year to date. The goods trade surplus soared to $785 billion in the first 10 months, according to data last week, which is now the highest on record for that period, and an increase of almost 16% from 2023. And we know there's some part of this is due to the elections, as of course China was afraid that President-elect Trump would actually win the elections and enact trade tariffs, and they wanted to export as many goods as possible. But there's a second factor here, is that China's economy is weakening and at a rapid pace, and their move is simple: let's export more goods, let's keep our manufacturing sector humming, and the only way to do that is to send more products overseas. The problem is there isn't a lot of demand there, and China has to continue to increase these numbers. We know that this is absolutely infuriating President-elect Trump, who intends to put a stop to us. The problem is the market may actually have something else in store first. With Chinese export prices still falling, export volume growth was enormous. The overall story of the economy is again growing off of exports. And we know if it wasn't for exports, and it makes perfect sense because China is the world's largest exporter. If we cut back their exports through tariffs or through a lack of demand, their economy, it's a foregone conclusion, is heading into a recession. The problem is it's already headed that. It's in the early stages and likely far ahead of most other developed countries, perhaps with the exception of Germany, who doesn't have any options to export its way out of its problems. China's trying to. They've done stimulus. It's not working. The problem is things are going to get a lot worse before they see any forms of tariffs. And let's take a look at what's going on here, because when we see the import price index, we're going to look at all industries for China. This is coming into the U.S. That's shown in blue on a year-over-year rate of change. And we look at U.S. imports of goods from China. Now, what we know, starting around 2012, we see some disinflation in terms of price index coming down, and then into deflation when the blue line crosses that horizontal black line. And at first, you see a dip in imports from China, and then they surge higher. And so this is the reaction that, well, prices go down, so we're going to import a lot of stuff, and U.S. consumers are going to buy them. The problem is, what happens if U.S. consumers don't? Well, in this case, they did. But look what then fast forward to around 2015. Remember, the global economy was headed into recession. We see China once again exporting deflation. We see a surge of imports, and then what happens? They come crumbling down as demand goes away. But then we fast forward, because again, China pulls us out of the global recession. At least that's what everyone believes. Well, really, by exporting deflation, that means consumers all over the world have a little bit more spending power, and that really helped the global economy. But let's now fast forward to what's going on in 2019. We we see, of course, import prices deflating. And what happens? You see a boost in imports again. Hey, prices are going down. Let's send stuff overseas. And then demand isn't there. This time, we're seeing a long trend of deflation here coming out of China. There's been this oscillating pattern of imports rising, then crashing down, then imports rising. The problem is what we're seeing here is if imports are rising and there isn't demand for U.S. consumers, well, what it means is we're going to see China enter a recession. There's no way about that they can avoid this. It's going to happen. So this recent surge in imports, yes, has everything to do with, of course, the tariffs, at least the threat of them, but it's also China trying to keep their economy afloat. If there isn't demand from the U.S. consumer, well, it's too little too late for China. And China's been relying more on exports to compensate for the weakness of domestic demand that Beijing has only recently tried to redress by injecting stimulus into the economy. And what did we say? It's not going to work. It isn't working at all. And the increasingly lopsided picture has generated pushback from a growing number of countries. And the new Trump administration is likely to impose tariffs that would reduce the flow of exports to the U.S. But maybe that won't make a difference. And that's what's interesting. I'm going to show you what's going on in the market here in a little bit. And countries from South America to Europe have already raised tariff barriers against Chinese goods, such as steel and electric vehicles. And Chinese companies have been ramping up their export performance over the past few years. By contrast, the slowing economy, increasing electrification, and rising replacement of foreign manufactured goods with domestic alternatives are suppressing demand for imports. So we know President-elect Trump is going to go out to China and say, here's the deal. We'll continue to import your goods, but if you don't start buying our stuff, we're going to impose some massive tariffs. Now, the problem is, internally with China, we're seeing demand is weakening and they're building consumption internally to meet their internal needs. So what does that mean for the United States? Well, you're going to better believe what's going to happen. It's all going to be focused on exports of agricultural commodities. Watch and see. Trump is going to demand that. Now, the result in October was the third widest surplus in history. They came just below June's record. The trade surplus calculated in yuan hit 5.2% of nominal gross domestic product in the first 9 months of this year, the highest since 2015. And well above average level for the decade. And this is something that looks to get worse because China doesn't have an answer for their economy. But something we think is going to ramp up in a big way, that is the stock for our sponsor for today's show, Resolve AI. You can find them on the NASDAQ under the symbol RZLV. And what we're seeing on this 10-day chart is a potential short-term setup. You have 1, 2, 3 bottoms here, all with support, particularly by volume. We think this brings it right up here to the 10-day volume profile line. That would be a 13% short-term move. Stay tuned to the end of the show or check out the pinned comment or description for more information. We'll show you the setup for the much larger move and why money is flooding into companies like Resolve AI and why we think they could be the next big hit. The surplus with the U.S. rose 4.4% so far this year from the same period last year, and it increased 9.6% with the European Union and jumped almost 36% with the 10 Southeast Asian nations in Asia, the latest data shows. And what we know about the European Union, well, their economy is heading into recession too. So China's dumping products on their shores as well. And one of the challenges, one of the perceptions that people have is if China's dumping cheaper goods into someone's country, it's going to put workers on the unemployment line as demand goes away, or you see a shift from U.S. consumers or other consumers to lower priced goods. And it makes perfect sense that that would happen because simply when consumers are strapped financially, they still need to spend, they still need to buy things, they're going to look for the lowest possible price. And right now, that means Chinese goods. But does it really have effect on the labor market? Well, it actually depends. When we look at the import price index, still shown in blue on a year-over-year rate of change, against the unemployment rate, well, we do know that going into the global financial crisis, that import prices rose, and well, that led to, of course, the unemployment rate rising and a recession. And you might think, well, that doesn't make any sense. But really, when you think about it, what happened is import prices rose. U.S. consumers couldn't afford them. They're going on to to unemployment anyways because demand in the U.S. was falling and the economy was slowing. And next thing you know, you hit a recession. But let's fast forward to where we are now, which is the only other data we have, given that we don't have a lot of data on import prices from China. And what do we see? A bottoming here in the unemployment rate, and it's starting to rise. But this is all in a matter of a deflating environment of import prices. So it's possible that China's export of deflation is keeping the U.S. economy afloat, at least for now. We'll see what happens because there's some other market forces that are happening here that could nullify the effects of what could be a big tariff coming from President-elect Trump. A currency war may be brewing as well, and this is a huge issue, as India's central bank has said it's ready to let the rupee weaken if China lets the yuan drop to counter U.S. tariffs. Of course, the yuan is already dropping, and that's one of the issues we're seeing. But this is really the big power move that China could do. They could let their currency weaken. They could give up on the fact that they want people to trade in yuan because, well, if it continues to lose value, people aren't going to want to. But their biggest deal is they could devalue. This is a big power move that China has in their back pocket. A falling yuan would make Chinese exports even cheaper and could further widen the trade surplus with India, which hit $85 billion so far this year, 3% higher than 2023 and more than double the level 5 years ago. So China's ace in the hole is really, we'll just devalue our currency. If you want to throw tariffs or something, no big deal. We'll just cut the value of our currency. We're going to keep exporting because we're going to fight to keep our economy out of recession. One of the problems is it's going to go into a recession anyways. And yes, there's going to be an all-out currency crisis as we now see the dollar on track for the highest in the year as the dollar continues on a tear. As soft demand as a major importer in China, and you see just in the crude markets that oil extended its biggest drop in almost 2 weeks, it's soft demand in major importer China and a stronger greenback dampened the outlook for crude. Well, what that's doing when you think about the dollar, as long as it continues to go higher, well, it's nullifying the effects of tariffs, or we have to put even bigger tariffs on this. And what is one of the big problems here is that President-elect Trump, he wants a weaker dollar. He wants it to go down in value because he wants to drive jobs in the U.S. manufacturing sector, and he needs that to happen through a weaker dollar. The problem is the dollar's on a tear. And why is it going up? Because of the threat of tariffs. Now, this is something a lot of people don't understand because people believe, well, we'll just put some tariffs on and then China will come right into line with what we want. The issue is you put tariffs on, the dollar's going to go even higher, the yuan's going to go weaker, and it's going to nullify the effects of tariffs in a big way. And here you can see the evidence of that. As we look at the nominal broad U.S. dollar index shown in red against the import price index, still shown in blue for all industries in China on a year-over-year rate of change. And what you see is a surging dollar leads to crash in import prices as they turn from disinflation to all-out deflation. How about right around 2011, the dollar goes on a run, and that brings import prices right down into contraction. The same thing happened starting around mid-2014, then once again around 2018, and here we see it again. The dollar heading higher is going to put downward pressure on the yuan, drive import prices out of China even lower. This is exactly what Beijing needs right now, is to drive deflation around the world, because that puts them at a point where they're more competitive than everybody else. And for the U.S. economy, this is dangerous news because U.S. manufacturers cannot compete. But will a stronger dollar keep China from heading to a recession? Well, unlikely, as we look at China's credit growth now disappoints as lending lags bond sales. And this is a problem because China is trying to stimulate in a big way. And we told you, all of their efforts are going to fail because one of their whole plans is, hey, we're going to pull some of this long-term debt out of the banking system. We're going to inject short-term debt on the other side of it to put liquidity, and the banks will lend and everything will be A-okay, except, well, it's not. As government bond sales accounted for more than 3/4 of all new financing and exceeded 1 trillion yuan for the third month. The total stock of credit grew at the slowest pace since comparable data begins in 2017. And if you want your economy to grow, particularly in a debt-based system, well, what you need is the debt to grow. That's how new money is created. That's how prosperity happens. That's how you get people to spend. And what we see is October credit data indicated credit demand of private sectors remain weak, and both households and corporate loan growth remain low. and the loan extension was mainly driven by short-term financing. And here we see the evidence. This is what central bankers do. This is what the PBOC did. Hey, let's cut some rates and that'll fix things and we'll inject some liquidity in the banks. And what happened? When we look at the U.S. data, you see commercial industrial lending shown in blue on a year-over-year rate of change against the federal funds rate. And you can see decelerations in lending are not reversed until you get a massive decline in the funds rate. But is it about the funds rate? Is that's what the magic is here? Is it you just cutting enough rates enough until things turn around? Well, I'm going to show you what the truth is, because it's not about central bank action. It's about the labor market. Because if you want people to spend, and that means they go out and borrow and spend, of course, buying things they don't need with money they don't have, well, you need to turn the economy around. And it all starts with the unemployment rate. You'll notice where you see declines in commercial industrial lending match periods going back to the 80s of rising unemployment. And as we move into the 90s, it gets even clearer. You see a rise in unemployment showing the unemployment rate here. That's the U3. You see a decline and a contraction in commercial industrial lending. Where does lending bottom? Well, it bottoms where unemployment peaks. You see that happen again here in the early 2000s, once again right around 2010. And now everyone believes, of course, the Fed is suggesting the unemployment rate can't go higher. Well, it's going to go higher, and that means commercial industrial lending here in the U.S. likely to fall. You want to know what China needs to do? They need to turn around their economy. They're trying to by exporting their way out of the problem. The issue here is demand around the world is declining, and the dollar is still rallying. That's dangerous news for the U.S. economy, dangerous news for our workers here, something I'm not sure that President-elect Trump has an answer to, because tariffs won't fix it. As corporate and household borrowing demand has been sluggish in recent years, as the worst property downturn in recent history dampened consumption and investment in many related sectors. As a result, China hasn't experienced the typical credit cycle seen before 2022, but rather a continued slowdown in lending, meaning that despite their efforts to weaken their currency and export their way out of this problem, we're seeing the global economy led by China and Germany is dragging the world into recession. The U.S. not far behind. The PBOC has indicated it's ready to ease monetary policy further, but as we noted, it won't work. In fact, they're lowering the ratio, frees up money for banks to lend and invest, but the issue is the banks have to want to lend, and that means consumers have to want to borrow. And when the unemployment rate is rising, we see youth unemployment in China at record levels. Well, that means the economy is weakening. It's not a good place. That means they're not going to lend. Banks have no incentive to do this, and it's all a foregone conclusion. As liquidity dries up and money goes away, economies, well, they go down, not up. And China's economic rescue plan leaves commodities stuck on pause. Of course, the world is on edge here. Delivered by the finance ministry on Friday afternoon, Beijing's move amounted to a hefty $1.4 trillion bailout to refinance hidden debt. Specific steps to revive consumption were lacking. And while raw materials may well benefit from the largesse, it is not clear how. Copper, iron ore, and crude oil prices all fell after the announcement, but something that we think could be headed higher and in a big way is a stock for our sponsor of today's show, Resolve AI. You can find them on the NASDAQ under symbol RZLV. We think they've got a 13% short-term move as a triple bottom forms on the stock chart, with a breakout potential of 63% as Wall Street is looking to fund companies in the AI space. We think Resolve could be the next big hit. Let's talk about how they are AI for commerce, and they're providing innovative new sales channels that help your customers save time and money. Again, everything you need to know in the pinned comment and description below, because they are AI for retail. Resolve Brain is an AI-powered platform for e-commerce businesses to optimize their online stores with enriched taxonomies, personalized recommendations, and conversational AI-powered shopping interface. And this is something that businesses want because they're losing sales on their website, and Resolve is looking to fix that in a big way. Let's take a look at some of their recent press, because Microsoft and Resolve AI have partnered up to drive global retail innovation with AI-powered commerce solutions. The potential for generative AI to transform retailers' business is immense, though this partnership will combine the power of Microsoft Cloud with Resolve's purpose-built solutions built on their unique Gen AI models to bring differentiated conversational AI experience to our mutual customers. Together, we can provide retailers with the tools they need to personalize shopping experiences and streamline operations at scale. And they're leveling up digital and commerce engagement By integrating the Brain Suite with Microsoft Azure, Resolve AI offers retailers scalable and secure AI capabilities backed by Azure's enterprise-grade infrastructure that are designed to reduce cart abandonment. For example, Brain Suite allows conversational engagement with digital and commerce channels in 95 languages, which can help retailers speed up the checkout flow as well as provide comprehensive, generated AI-supported customer support. Additionally, Azure customers will benefit from pre-configured solutions that streamline deployment, offering rapid return on investment and operational efficiencies. And they've got extensive go-to-market and co-sell supports in terms of marketing, co-sell support, and ISV success benefits. And Microsoft can resolve AI strategic partnership to disrupt $30 trillion retail sector with AI-driven solutions. As part of the partnership, Microsoft is committed to supporting Resolve AI with go-to-market initiatives, which is expected to reach a minimum of $130 million over the next 5 years. These go-to-market efforts will fuel global market penetration by connecting Resolve AI with top retail customers across 3 major continents each quarter, and will drive Resolve AI's target of over $100 million ARR for 2025 and accelerate growth over the subsequent years thereafter. The financial backing underscores Microsoft's belief in Resolve AI's potential to transform the retail sector through its powerful suite of solutions. And Resolve AI leads empathetic conversational commerce revolution with Microsoft endorsement. They applaud Sierra's $4.5 billion valuation as a milestone for AI-driven engagement, and this could be the catalyst that sends Resolve AI stock as they look, we see, from Wall Street to fund companies like Resolve. And in the AI space, the $175 million investment in Sierra by Green Oaks, Iconic, and Thrive Capital reflects the industry's recognition of empathetic AI as a transformative force. Resolve's AI's proprietary brain power model is at the forefront of this revolution, equipping retailers with tools that enable genuine, engaging, and highly personalized customer journeys. Together with Microsoft, we're setting new standards in conversational commerce, helping businesses around the world harness the power of empathy through AI. And one thing we think that you can harness is the upside potential in their stock. Let's look again at the short-term play here. Around the 10-day chart, you see a triple bottom forming. Support is there, and with volume, as we can see in today's chart setup, and a move from today's price at the time of filming up to the 10-day volume profile would be a 13% move. But if you see money and attention driven into Resolve through Wall Street, well, we think there could be a much larger move up to a 6-month volume profile line, and that would represent a potential 63% remove for Resolve AI. Again, you can find them on the NASDAQ under the symbol RZLV. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.